It's simple to start investing. It's much tougher to choose the correct investment strategies. If you merely avoid these 10 major blunders as a new investor, you can save yourself a lot of losses. So make sure to stay till the end of this video. Hey guys, welcome back to Economy Expert. Today in this video, we'll be discussing the top 10 mistakes new investors make. But before we head to our topic, make sure to subscribe to our channel Economy Expert for more such economy content. That said, let's have a closer look. Number 10. Letting your ego to impede you from cutting your losses. Really, who wants to be proven wrong? Admitting you were incorrect in an investment decision, as in so many other aspects of life, is a very disappointing proposition, but it's still far preferable to sticking with a poor choice only to protect your pride. Ultimately, investing is more about capital than it's about winning. If you retire, your pride won't be enough to maintain a roof over your head and food on the table. Gains from your investments will. Number 9. Letting your emotions control your investing decisions. Gains and losses from investments. Just money or more? You'd be amazed at how frequently emotions affect an investor's decision-making, particularly for a novice investor. Investing can involve greed, fear, and even euphoria. Learning to control these emotions without allowing them to dictate your approach is a necessary step in developing from a novice investor to an expert one. Greed may be driving your investing if you find yourself buying stocks with rising share prices and become fixated on purchasing them. Despite the fact that you definitely desire to profit from your investment, greed frequently causes you to chase after irrational short-term advantages. What should you do if you notice that your financial decisions are being influenced by your emotions? You should reconsider how you pick your investments. Some investors set quantitative requirements that must be met before they'll consider an investment offer. Number 8. Trading too frequently or quickly. Investing is not a get-rich-quick scam. It's a long-term money producer. Without having a reasonable expectation going in, you can become impatient with the results that you're getting or stressed out about typical drops, which could lead you to make the error of trading stocks and other assets too soon. Frequent traders also pay more in fees than long-term investors who stick to a consistent strategy. Investors also need to be cautious of the tax impact. You can be taxed on the money that you earn in the stock market, but long-term gains or gains on assets that you've owned for more than a year are normally subject to lower rates of taxation than short-term gains. Even if you achieve the same gains through frequent trading as you would by maintaining your assets for a longer period of time, the difference in tax rates means that you keep less of the money that you earn. Number 7. Making excessive losses without a plan. Losses are a common part of investing, but you still want to reduce them. By having a strategy, you can avoid severe losses and recover more quickly from modest losses. Can you spot a declining trend in time to cut your losses? Most novice investors are unable to. While you don't want to abandon ship at every small setback, you also shouldn't hang on to a losing investment as it continues to decline and carry your capital with it. Your investing plan should include the ability to act swiftly and decisively when you reach your breaking point. Finding that breaking point is the initial step. You won't find yourself basing your approach to losses on feelings and intuition rather than on reliable statistical data if you establish a threshold for the maximum losses that you're comfortable with right away. You can reassure yourself that some loss is normal and that the quantity you're seeing is still within the permissible range when you analyze your losses. You know it's time to sell your investment before it falls much more, when your losses have surpassed that tolerable level. Number 6. Failure to rebalance your portfolio. A broad portfolio isn't something you can just set and forget. Regularly assessing and intelligently modifying your investments is the definition of smart investing. Even as markets shift, you want to make sure that your portfolio remains diverse and well-balanced. Reassessing how your asset allocations stack up against your overall investing strategy and financial objectives is necessary when rebalancing your portfolio. If your portfolio and your plans are not in sync, make the necessary adjustments to your portfolio or investment strategy to bring them into line. Number 5. Failure to diversify your portfolio. Diversifying your portfolio is an essential step in risk management. This means that you shouldn't put all of your money into one form of asset, such as stocks, bonds, or cash. If you're paying close attention to asset allocation, it goes without saying that you won't put all of your money into one kind of asset. However, there is a distinction to be made between distributing your investment funds throughout several asset classes and having a completely diversified portfolio. You cannot diversify your portfolio before you've purchased enough assets. Finding a balance that works for you is more crucial. In the end, you should work to optimize your portfolio's asset allocation such that you're getting fair returns and an acceptable amount of risk. Number 4. Being unrealistic about risk. Investments involve risk, but risk management is a must. You must form a realistic idea of how risk will be integrated into your life as an investor before you can think about how to manage risk financially and minimize your losses. It's more difficult than it seems. Nobody wants to invest and lose money. However, almost all investors will experience a loss at some point. Dips are a natural element of market turbulence. It's good news that these losses usually level off over time. Investors who venture into the market with a strategy and stick with it over time gain much more money than they lose, despite occasional losses. It's a good idea to base your investment strategy on your risk tolerance, but if you can't reconcile your views about risk, you'll probably end up abandoning that strategy. Mistake number 3. Prioritizing asset allocation over individual stocks. Individual stock selection is a gamble, not an investment strategy. You're making educated guesses about market winners and losers. There is always a chance of losing, regardless of how much research you do. It's therefore preferable to place an emphasis on asset allocation and to spread out your assets by utilizing index funds, which are a collection of equities. Making an unbiased choice based on the data is challenging when you're concentrating on specific stocks. It's simple for well-intentioned qualitative research that focuses on a product's consumer appeal or brand recognition to cross the line into confirmation bias. Instead of maintaining objectivity, you believe the company is a smart investment because you enjoy it personally. By conducting more research, you can counteract the tendency for people to interpret evidence subjectively. But it takes a lot of effort to dig into the specifics required to thoroughly examine each individual stock. As a result, a lot of investors who purchase individual stocks don't conduct their due diligence. There is a simpler method. Rather than stuffing your portfolio with shares of individual stocks, concentrate on asset allocation in general. Mistake number 2. Making investment decisions without considering strategic projections. How can you distinguish between good and terrible investment opportunities when it's time to make a decision? You might be doing something very wrong if your strategy is to focus on how a stock or other asset is currently performing. Financial investment market performance is cyclical. It may seem safe to invest in a stock or a business that has done well over the past several years, but past success is not always indicative of future success. The truth is that just because you've heard something is a smart investment doesn't necessarily mean that it is. There's a good risk that you're making financial decisions based on false information. Contrary to popular belief, investing is not a passive form of income generation. You're making a serious error if you don't conduct the necessary research before you purchase or exchange assets. Mistake number 1. Not having a trading strategy. Before you even begin investing, it's possible to make some serious errors. You need to consider your options wisely before you start purchasing, selling, or trading. You require a comprehensive investing strategy that takes into account your resources, objectives, and overall financial status. In terms of compound interest, generally speaking, the earlier you start investing, the better. However, financial planning includes more than just investments. Jumping into the stock market without first considering your whole financial status could end up costing you in the long term. Don't invest funds that you will need right away, like the down payment for a house that you'll be buying in a year. You won't have enough time to make up for any losses before you need to withdraw the funds. Please make sure to do your own research thoroughly and then invest accordingly. The content in this video are for educational purposes only. And that's all for today. Thanks for watching. Let us know your thoughts on what your investment plan is in the comment section. And if you enjoyed this video, then please like, share and subscribe to our channel, Economy Expert, for more such amazing content.